Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Aisha Hunt, founder of Kelly Hunt, a firm which specializes in helping asset managers with legal aspects of their business, including launching ETFs, converting mutual funds into ETFs, and other investment products across a wide variety of asset classes. And we know that ETFs have become the vehicle of choice for many investors, particularly younger ones. Mutual funds, in fact, have been losing assets at a record pace while ETFs are gaining assets. And that resulted in a $1.5 trillion gap in the flow of money from mutual funds into ETFs last year in 2022, after about $1 trillion each in 2020 and 2021. That is according to Bloomberg data. Now, ETF market share relative to mutual funds has increased to about 30%, up from just about 13% over the last decade, and that is according to CNBC. But ETFs still have a ways to go because mutual funds still have about $17 trillion in AUM, and the mutual fund structure works best in certain areas like 401ks. But because of investors' preference for ETFs, many providers are converting their mutual funds into ETFs or launching ETF clones of their successful mutual funds. And that trend is going to accelerate in the coming years. So we will talk about all these conversions, clones, and another important topic that we are going to cover today is ETF providers applying with the SEC to offer ETF share classes of their mutual funds after expiry of Vanguard's patent. So I'm really excited about this conversation, and Aisha is the perfect guest to discuss these topics. Aisha, welcome. Great to have you with us today. And since you're joining us for the first time on this show, please tell us a little bit about yourself.
Thank you for having me, Nina. It's truly a pleasure to join you. I very much, look forward to discussing emerging trends in the ETF space and, various approaches that issuers are taking to raise assets through, various initiatives. My firm, Kelly Hunt, I founded it over 2 years ago. It's the only women and minority-owned law firm in the institutional asset management space. It really represents the culmination of over 2 decades of my legal and business experience in the institutional asset management space. My experience includes serving as Associate General Counsel at Dodge & Cox, Senior Legal Counsel at Wells Fargo, General Counsel at Alps, and Viden Asset Management, as well as leading the financial services practice in San Francisco at Deckard, and really trying to leverage both my in-house experience and my outside counsel experience to provide legal services that really leverage the best of both of those worlds and to meet clients where they are. And so our firm exclusively focuses on serving all of the legal needs of asset managers, from RIAs to institutional asset managers that manage mutual funds, ETFs, CITs, interval funds. As you mentioned, we specialize in, working on novel ETF initiatives, mutual fund to ETF conversions, launching ETF clones. We also have a significant interval fund and issuer tender offer fund practice. So we really try to meet all of the legal needs that an institutional asset manager would be looking for from a law firm.
Excellent. So let's start with the Vanguard's patent. So this was a very unique patent. This expired in May this year, and this allowed Vanguard to offer ETFs as a share class of their existing mutual funds. And this structure greatly benefited investors because it allowed Vanguard to lower their expense ratios through economies of scale. And it also allowed them to use tax efficiency of the ETF wrapper and the in-kind creation and redemption process. So that is why Vanguard's mutual fund and that have an ETF share class, they rarely distribute capital gains. So could you tell us about, explain this structure to our listeners who are not very much familiar with this structure, and tell us how it benefits investors?
Sure. So, as you mentioned, Vanguard has had a patent on a mutual fund and ETF share classes for its funds. And so ultimately what it was able to do was to use one fund that would allow investors to invest through a mutual fund share class and an ETF share class. Both of those share classes were share classes of the same funds, and so shared the same underlying portfolio. As a result, Vanguard was able to use the ETF share class of the fund to realize tax efficiencies, and as you mentioned, to defer capital gains, and in some cases, completely eliminate capital gains. So Vanguard was able to do that for those funds with what we refer to as dual share classes, and it's only through having an ETF share class in addition to the mutual fund share class that allows you to use those portfolio management techniques to create those tax efficiencies. So the benefit of that is, if a fund buys Apple at a low cost basis, an ETF wrapper allows you to basically, eliminate the capital gains associated with selling, a portfolio security with a lower tax basis. And so you're able to basically use the in-kind feature of a ETF to replace that lot of securities with a lot at a market tax basis, and essentially defer and eliminate capital gains. So that's a little technical, but the reality is that that's what we mean when we're talking about tax efficiencies associated with using an ETF wrapper. It's using that heartbeat trade portfolio management techniques to essentially suck out the capital gains of a portfolio. So being able to bolt on an ETF share class to what would traditionally be a mutual fund is an incredibly valuable product attribute that everyone's exploring. In the wake of the expiration of the Vanguard patent in May, and so there are several issuers, one of which we represent, FM Investments, that manages a U.S. benchmark series that has sought relief, and I welcome sharing more about that, the novelty of that exemptive application with you.
Right. So 3 ETF providers, including Dimensional and Fidelity, have filed with the SEC to adopt this Vanguard's multi-share class structure. But the difference is that these providers want to use this structure for their actively managed mutual funds, whereas Vanguard's patent was used for passively managed index funds. So the arrangement has many benefits, but some drawbacks too. There could be some negative tax consequences for ETF investors, which may result from actions of mutual fund investors and may trigger some capital gains taxes for ETF investors. And in the past, the SEC had raised some concerns, including possible cross-subsidization. So we do not know whether the SEC will approve this structure or not. But what are your thoughts on the possibility of approval and whether the providers are trying to address SEC's concerns?
Those are all very important issues that the SEC has raised. And so the SEC has shared that they're very focused on any application to obtain this dual share class relief, having both a mutual fund and ETF share class, similar to the Vanguard model, that these cross-subsidization concerns are addressed. And so the SEC has said they're going to look closely at the facts and circumstances of the particular ETF issuer and take into account policy considerations in determining whether or not any application for this dual share class relief can, sufficiently address their concerns. One of the more significant cross-subsidization concerns the SEC has raised is cash drag. And so when portfolio managers are managing a mutual fund, they have to allocate a certain portion of, the mutual fund's portfolio to cash to be able to meet cash redemptions of mutual fund shareholders. Because ETFs can trade in kind, ETFs don't have to reserve, that portion of their portfolio to meet, cash redemptions of shareholders. They can meet those redemptions in kind. And so the SEC was concerned about what they refer to as a cash drag, where when you have both share classes, would, the ETF shareholders suffer because the underlying portfolio had to reserve more cash to meet the mutual fund share class, cash redemption requests. And so one of the things that, has tried to be addressed, and, we have 4 applications on file since Vanguard's application, and those live applications include applications from Perpetual, Dimensional, our client, FM Investments that filed along with RBB, and more recently Fidelity filed. Our application that we filed on behalf of FM Investments and RBB has the best facts and circumstances because it's making the case that the SEC should grant this relief for FM Investments U.S. benchmark series. And the U.S. benchmark series are single treasury issued ETFs. And so the underlying portfolios consist of highly liquid treasury securities. And so, as we mentioned in the application, SEC Chairman Gensler, has been, very transparent in public speeches that the U.S. Treasury market is the most liquid market in our capital market system. So as a result, when an ETF or a mutual fund is managing a highly liquid portfolio consisting primarily of U.S. Treasuries, there's no need to reserve cash. That the cash drag concern is not applicable with a single issue Treasury, fund, because inherent in the portfolio management of U.S. Treasuries is managing highly liquid securities that are, essentially cash equivalents. And so we think that the FM Investments RBB filing is the strongest because the cash drag concern is not applicable. And so with other applications, they're making a case for how to address the cash drag, but it's not as sufficiently addressed as it is in the application that we filed for single issue Treasury ETFs. The other issue the SEC is concerned about is either the mutual fund share class or the ETF share class, subsidizing expenses, the other expenses of the other share class. In the application that we filed for FM Investments and RBB, we propose that since these are existing, single issue Treasury ETFs that currently charge a unitary fee, and a unitary fee differs from a traditional mutual fund fee, and that the manager, the ETF issuer, pays other expenses. Those expenses are not passed to fund shareholders. And so by using a unitary fee, you don't have to be concerned about a share class subsidizing the expenses of another share class. And so in the FM RBB application, we're proposing that the U.S. benchmark series ETF family add a mutual fund share class, which would give it access to the 401k distribution channel, result in greater economies of scale that benefit all fund shareholders. And there would be no concern not only with respect to cash drag, but there would be no concern with respect to the subsidization of other expenses, because a unitary fee would be utilized for both share classes, whereby the manager would pay the other expenses. So we believe that the application that we filed, directly addresses the SEC's concerns, unlike the other live applications that the SEC is considering. So we're very optimistic that we've put forth the best facts and circumstances, and are very hopeful that we'll be able to obtain relief from the SEC.
Right. So there are 3 applications to offer ETFs as a share class of their existing mutual funds, and the FM investments that you are working on, they have filed to offer mutual fund share class of the ETFs. And that makes a lot of sense to me because that will allow investors to access ETFs in their 401k accounts, right? So do you think, and all these applications, they look, they make a lot of sense to me because these will offer investors a lot of choices. They will benefit investors, but basically investors get the best of both worlds. So do you think that we will see many such applications in the coming months? Many other ETF providers will also file with the SEC to adopt these structures.
I think you will see, some additional applications, but I think the vast majority of issuers will probably wait until one or more applications is, green lighted by the SEC. So once exemptive relief is obtained, absolutely, you'll see, I think it'll open the floodgates because to your point, Nina, issuers want to make sure, and it's consistent with their fiduciary duty to make sure that they are doing what's best for fund shareholders and offering them the best of both worlds. And so, if you can offer the attributes, the best attributes of ETFs, tax efficiency, intraday trading, and other benefits of ETFs, along with the benefits of mutual funds, you can, there are certain attributes like, automatic dividend reinvestments, certainly being able to access mutual funds through your, 401k platform. If you can bring those, attributes together and offer the best of both worlds, then, you essentially have a fiduciary duty to consider whether to bring a product like that to market, whether you're a mutual fund family and you want to add an ETF share class, or you're an ETF family and you want to add a mutual fund share class. And, I think it's particularly exciting for, the ETF families to potentially access the 401k distribution channel, which right now is approximately a $6 trillion distribution channel. And currently 401k platforms, are supported by legacy technology that doesn't allow supporting ETFs. And so it's certainly in, it would be in both share class shareholders' best interest to be able to realize the largest benefit of economies of scale by growing assets through either the ETF or mutual fund share class, depending on the investor's preference. And so we think that this is a compelling development in the ETF and mutual fund space. And we really do believe that the SEC has raised some very valid concerns, but that can be adequately addressed and ultimately benefit all fund shareholders that would come in through the class of their preference.
Right. Now let's talk about the conversions because some asset managers, including Dimensional, JP Morgan, Fidelity, they have converted their actively managed mutual funds into ETFs. So they are bringing these mutual funds with established track record and AUM to the ETF market. And in fact, Bloomberg analysts estimate that about $1 trillion worth of mutual fund assets could be converted into ETFs over the next 10 years. So let's talk a little bit about converting mutual funds into ETFs because your firm helps ETF providers with that as well. So please tell us how the process works and what are the implications for investors. Are there any possible tax implications that investors should be aware of?
Absolutely. I mean, the biggest benefit, as you mentioned, in converting a mutual fund to an ETF is to be able to bring the scale of the existing mutual fund assets to, a new ETF, as well as to port the track record, the performance track record, right, which assist in getting additional distribution traction. I mean, all of these are aimed at, two primary objectives, continuing to raise assets to benefit fund shareholders through economies of scale and reduced expenses, as well as to realize the tax advantages to defer and potentially eliminate capital gains to the benefit of fund shareholders. And so, those objectives are quite compelling. It is a heavy lift with respect to converting a mutual fund to an ETF. I think one of the most important considerations is, whether the mutual fund is well suited for conversion. One of the first considerations that managers are taking into account is, what is the mutual fund shareholder base? If the mutual fund shareholder base is, primarily consists of, 401k shareholders, then, you wouldn't want to forego that 401k shareholder base that wouldn't benefit from any tax efficiencies of an ETF wrapper. It wouldn't be a good, so if you have a mutual fund with a majority of 401k shareholders, it probably isn't a good candidate to convert to an ETF, since those 401k shareholders wouldn't benefit from the tax efficiencies of an ETF wrapper. Secondly, you want to, be engaged in, extensive discussions with, your portfolio management team and your legal counsel around, the mechanics of doing this, and understanding that, if you're going to convert a mutual fund to an ETF, an ETF, as we just discussed, currently is only permitted to have one share class, right? And so a lot of mutual funds have, multiple share classes. You're going to have to convert those share classes into one share class. Additionally, ETFs are purchased through brokerage accounts. There's a lot of shareholder communication that has to be, facilitated to make sure that the mutual fund shareholders, existing mutual fund shareholders, are provided with, clear instructions, directions, guidance, and support to make sure they have a brokerage account established to be able to receive, ETF shares in connection with the conversion of the mutual fund to an ETF. Also, mutual funds issue fractional shares. ETFs don't. There needs to be a clear plan around how to address those fractional shares. There are complications associated with mutual funds that have 12B1 plans, and how to address that in the context of conversion. So there are a lot of very significant considerations that should be discussed very closely with the executive team of the mutual fund manager, including the portfolio management team, as well as legal counsel and trust counsel. And our firm, what we try to do is we not only assist in effecting conversions, but we also operate as consultants, right? Sometimes managers, want to make sure they understand all the issues at the forefront, and it takes a while to think through all the issues and to socialize those issues within the team internally. So our firm will come in on a consulting basis. We don't necessarily have to be your trust counsel. We can come in and just work with your executive team, your portfolio management team, and walk through the issues with you and help you customize analysis of whether to convert a mutual fund to an ETF before you actually greenlight the initiative with trust counsel. So we're willing to plug and play to be a resource in any way we can to help the existing legal team, if there's an existing legal team contemplating it or trying to support their executive team and considering the conversion, because there are a lot of considerations and technical issues, and you want to make sure you fully understand all of those issues, the lift, the timing, and how the various groups within your team would be impacted by a conversion.
On the other hand, some ETF providers are launching clones of their very successful mutual funds. So basically bringing the star power of these star managers in tax efficient wrappers. So I was interested in your thoughts on the two, conversions versus cloning. Which one is better in your view? And will we see more clones going forward or more conversions?
It's really dependent on the product suite and the specific funds involved. Theoretically, a mutual fund to ETF conversion has, there's significant ROI in being able to bring that scale to a new ETF, as well as a track record, as we've discussed. But let's say you do have a mutual fund that has, a substantial 401k shareholder base. Maybe you don't want to in any way disrupt that shareholder base and create, the additional steps that shareholder base would need to do, take to accommodate a conversion. And you just want to offer an ETF clone version, basically mimic the strategy of your mutual fund and offer it through an ETF wrapper for a different demographic of shareholders that would benefit from the tax efficiencies of an ETF wrapper. So there's certainly, various scenarios under which cloning or mimicking an existing mutual fund investment strategy, through an ETF wrapper makes a lot of sense. But again, that's why it's really important to have, a discussion in depth with, outside counsel and your internal team to understand the issues so that you can do a thorough analysis about what's in the best interest, of the shareholders, as well as what's in the best strategic interest of the asset manager. And when you're thinking about, your entire product suite, you're thinking about product rationalization. How can you have a fund family that complements one another, right? So that you're, optimizing the AUM of the firm, which ultimately, hopefully, is benefiting, all of your fund shareholders. So I think it's important to understand all the issues and work closely with legal counsel to assess the facts and circumstances of your particular product suite and each fund that you're contemplating either converting to an ETF or determining whether it makes sense to clone and mimic that strategy to launch an ETF and try to achieve those tax efficiencies through the ETF wrapper.
Switching gears a little bit, let's talk about spot Bitcoin ETFs because there's so much excitement Bitcoin has rallied in the past few weeks, or maybe I should say past few months since BlackRock filed for a spot Bitcoin ETF. So do you think we will see a spot or many spot Bitcoin ETF in 2023 or early 2024?
Well, the spot Bitcoin ETF product initiative has been on quite the journey and certainly has been, top of mind for a lot of folks. It's a very exciting product initiative and it's been quite the journey so far. I do think that, Grayscale prevailing, in its lawsuit with SEC, significantly reduced the headwinds to bringing a spot Bitcoin ETF to market. A lot of big players have filings that are pending. There's an ETF issuer that had a filing pending to convert a Bitcoin futures ETF into a spot Bitcoin ETF. And the deadline for the SEC to revert back was actually, I think, today. And so a few days ago, the SEC, punted, that conversion, filing. And so as a result, I think that's really a bellwether for, the journey's not quite over in terms of bringing a spot Bitcoin ETF to market. I think the SEC, staff is contemplating, what's the best way to move forward and greenlighting these products. Do you greenlight, multiple products at once? Does it make sense to try to gate these funds at the same time so that there's competition and you're not having an over concentration with one fund family or another? But I think the popular wisdom is that while there's some potential for spot Bitcoin ETF to be greenlighted by the end of the year, it's more likely that multiple spot Bitcoin ETFs would be greenlighted in Q1. I think that's where everyone's bet is right now, or most folks bet. And I think it's going to be an exciting time, and it's going to open a new chapter to an asset class that not only will move the needle, in the ETF space, but also move the needle in the Bitcoin space, right? Which continues to be, while it's a volatile space, it's still, emerging, and I think people are excited about, how what can happen if you have ETFs that are, growing and purchasing spot Bitcoin and doing it through, reputable custodians like Coinbase. So everybody's really excited about this next chapter. And I think, it's inevitably going to, really move the needle in a lot of different ways in the financial services industry and in the digital asset space.
It is very exciting. As you mentioned, it's been a long journey, more than 10 years. Many issuers have been trying for more than a decade. And I agree with you. Probably we will see many spot Bitcoin ETFs making their debut in the first quarter of 2024. So these are some very interesting developments and initiatives, and more innovation, more choices are always great for investors. Are there any other developments that you're really excited about, and are there any concerns?
I think, related to the spot Bitcoin ETF initiatives, we've seen managers file for Ethereum futures ETFs. The SEC is, punted on that a little bit, but I think that's coming. I think it's around the corner. I think we're going to see, Ethereum futures and, a proliferation of Ethereum futures and spot Ethereum ETFs. And so I think that, we're going to see an uptick with that. And what's interesting about that, everyone's always focused on ESG, and ESG is in the eye of the beholder, right? In terms of what's ESG, what's anti-ESG, what's, ESG adjacent. And I think what's interesting about Ethereum based products, whether it's Ethereum futures ETFs or spot Ethereum ETFs, is that, it's at least ESG adjacent, if not ESG, because Ethereum has been characterized as mining Ethereum now entails less electricity consumption, and so some folks are viewing it as the ESG friendly digital asset class, right? And so you may have folks, if as Bitcoin ETFs and spot Bitcoin ETFs and spot Ethereum ETFs become a little bit more mainstream as an asset class, you could see greater allocations to Ethereum based ETFs, because they're theoretically more ESG friendly as a result of reduced electricity consumption in connection with mining. So I think there are some cool, interesting themes that might emerge from that. And so I'm curious. Again, we're in the early days of the asset class utilizing the ETF wrapper, but I think it's exciting and interesting, and we'll certainly have all of us engage with our clients to help them understand what's available in terms of product options in the space.
So we haven't seen a lot of interest in Ethereum futures ETFs that made their debut recently, because I think most investors are now waiting for the real deal. They're waiting for the spot Bitcoin ETF. And I believe that spot Ethereum ETF will not be far behind. We'll probably see spot Ethereum ETFs also launching in the first quarter of 2024. So those are really exciting developments, but we'll have to leave it there. Aisha, really enjoyed the conversation. Thank you so much for joining us today and for sharing your insights.
Thank you so much, Nina. Truly a pleasure.
That was Aisha Hunt. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so that you do not miss any episode. You can find us on all major podcast platforms. You can also find all of Zach's podcasts on our YouTube channel, Zach's Podcasts. If you have any comments, questions, or suggestions, please email podcast@zax.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.